This market is protected by the Federal Reserve. Okay, first off, read this disclaimer carefully. Okay, we are in this video going to look at a market that is literally getting bought by the powers that be, the Federal Reserve, and also many other central banks. So this is in the fixed income space, and let's be clear, the fixed income market is way more powerful than the stock market. The ETF in question is the now a bit infamous LQD is the ticker, iShares Investment Grade Corporate Bond ETF. A pretty meaningful move from the low and pretty close to 52-week highs. If you look at the seasonality of this ETF, it becomes very interesting. So this is all the history we have. We are currently in the later part of June. You can see that we are literally heading towards the strongest months for LQD. So you can see that July and August are very strong. That obviously helps the bullish case. Also helping the bullish case is that, the Federal Reserve is literally buying these. They are not supposed to buy corporate bonds, but they are doing it, and there's no real opposition. You have a bunch of economists who are complaining, but doesn't seem to have any effect. Okay, so this is the weekly data points, long-term picture going all the way back here, to the beginning, 2002. You can see that this ETF, it did go down during the financial crisis. It actually reached a high in 2003 and was making lower highs and lower lows throughout, so it certainly predicted a lot of the bad news that were to come. You can see that during the total crash we had during the pandemic, you can see it completely collapsed. This collapse is just absolutely shocking, and given that the bond market is so important and powerful, this was like a complete state of emergency. And the full consequences of the bond market imploding would be like cataclysmic. It literally could create a situation where markets were just closed. Like literally you would not be able to trade. Total shutdown. However, another solution was to have the Federal Reserve save the day, and they have been buying hand over fist. This extreme move is because of that. And also when people hear that the Fed is going to support it, then people were like buying LQD. It was like a no-brainer trade. So you can see that we are pretty close to all-time highs. We've made a sizable move, seeing a little bit of a pullback at the moment. The interesting thing, of course, is the seasonality. You could make a case that maybe due to the massive intervention by the Fed that the seasonality could be distorted. We don't know, but the trend was pretty clear. There's good reason to think that we are going to do a bit of a breakout. Well, a closing breakout, because here we did break out to a new all-time high, but we didn't close there. But we are really close. We are really not that far away. It doesn't take much to make that move. Accumulation distribution shows that the buyers are certainly stepping up. There is a 62% positive correlation with S&P 500, which we do expect, given that these are, corporate bonds, but it is not like a super strong correlation. RSI is in the neutral zone. If you look here at daily data points, let's zoom out to get the moving averages. So you can see that we have been pulling down a bit to here the purple 20-day moving average. It's been, a key level here before, so definitively a level to watch out. Watch out for that level. We are so close to all-time highs though. So having a little bit of a breather now and then making the move, that makes a lot of sense given the seasonality. And that's probably something many institutional investors are thinking about as well. One of the benefits of the bond market is that as a corporate bondholder, you have a higher priority than stockholders. So you will be healed first, so to speak. So it is more powerful, and I see a lot of people in the stock market, they want to get into like dividend stocks and the things that if you are like you want income, then seriously think about option strategies that give you credit. and also the bond market. I think that a lot of dividend investors, they are people that really should be bond and option traders. But anyway, we are super close to new highs. We have extreme bullishness in the sense of the Fed literally supporting this market. You can see the move here, it is just shocking. And the seasonality here is very interesting. June is one of the weakest months, given all the history we have here. July and August are around the corner, and it would make sense for the combination of catalysts here to push it to new all-time highs. This is basically decked for the bulls. I mean, the bulls would need to do something really messed up to screw up this opportunity. I mean, so yeah, a bit of a breather, and then making the move makes sense. Okay. Here you can see that you are paid a 3% dividend with this one. That's good. Options are available, so you can get more leverage. It's shortable. But given that, you have the Fed being this aggressive, I would not feel... I'm not sure I would sleep that comfortable being short something like this. Here you can see some performance. Okay, so let's talk a bit about bonds. Okay, how trade bonds. So there's three ways you can trade them publicly, like with the LQD. And that's more of an indirect way as well, given that you're doing it through an ETF. They can also be traded privately and over the counter. There is a common saying, and there's a lot of truth to it, that the bond traders are smarter than the stock traders. The bonds are more... They're more like a big-brained product, which also means that if you go to like bond forums, you will see that the climate is far more interesting than what you have on like a stock forum. So I would definitively recommend you look a lot more into the bond market, because it is very powerful. It very often leads the stock market. Yeah. The bond market is way bigger. Bonds can usually be traded between investors leading up to what is called, the maturity date. So you do not have to hold the bonds. That's one of the misconceptions people have about bonds, is that when you buy it, you absolutely need to hold it. You can trade a bond. The bond issuer does have the option to repurchase the bonds. And bonds are certainly considered to be safer than stocks, because you simply have a higher priority. If, as an example, a company were to go bankrupt, then the bond holders, they will get their money back. Well, at least they will be tried to make whole before the stockholders. And being the VIP, that's pretty cool. The essence of the bond market is that it is all about debt. Given that we have an economic system that is all about debt, and more debt, being able to own debt means that you have a pretty good position. You just do. So to definitively think about the bond market. It is heavily underestimated by so many people who are like obsessing about stocks and cryptos and stuff like that. Because I think stocks and cryptos, of course, are really interesting. But I look at all the markets. That's how you can get, much richer perspective on financial markets. Okay, so let's look a bit at this ETF. So the expense ratio is 0.15%. It is. Let's look at the dividend and valuation. PE doesn't really make sense, but dividend is something to look at. Okay, so you can see that there is an ETF here with a higher dividend, almost 6%. That's the Principal Investment Grade Corporate Active ETF. So yeah, it does have a bigger dividend. So let's look a bit at the holdings. Few more charts. Here you can see some sector breakdown, coupon breakdown. You can see, the percentages. the credit quality, you know, AAA, that's pretty good. Then you have, of course, the lower grades as well. There's the maturity breakdown. There you can see some companies, you know, pretty famous companies as well. You know, CVS Health, Goldman Sachs, you know, Microsoft. Hence, let's say that you are, you know, bullish on Microsoft. You could, of course, express it through trading the stock. You could also get into the bond market. And with the bond market, you have certain privileges that you simply do not have if you just hold the stock. So you probably have some favorite companies yourself. You know, maybe it's Apple or who knows. Think about maybe you want to get into the bond market for that company. Okay, so my summary here of LQD. The seasonality is looking pretty darn good. The Federal Reserve is literally protecting this market. Of course, the Fed's powers are not unlimited, so that's something to be a bit wary of. We do not know how far they can push it and still have legitimacy. This has worked so far, but that's a bit of the caveat. You know, maybe they will stretch the rubber band too much. That's a possibility, which is why you want to be diversified. Yeah, we haven't had a pullback. All the stars are pointing towards a breakout to the upside. However, if we were to see that not confirmed, you know, when basically what is supposed to happen doesn't happen, if that happens, like factor X all of a sudden hits the scene, then, you know, all kinds of pandemonium could happen. So basically, the coming months for LQD are rather important. Okay, US 500, let's look at the futures. S&P 500, okay. Yeah, we have a bit of a weakness so far today. This is the futures markets. You can see that we were below the 200-day moving average. That's a bit, you know, it's not a disaster, but it's a bit spooky. Because it is a pretty darn important moving average. It's watched very heavily, and the bulls definitively want to see this hold as support. They do not want to have a slip below here, because then there is a possibility of it turning into a resistance level. So yeah, very important times for the S&P. Given that we are not done with June yet, and June is a weak month for the stock market, the bulls do have a lot of work, a lot of energy that they need to spend going forward, because they absolutely need to push and push and push and push and push. It is quite interesting to see how the dynamics have changed. One of the big questions, you know, is that given that Federal Reserve have, you know, they have changed what they do. Back in the day, they would support certain aspects of the bond market. Now they are also supporting corporate bonds. One theory is that the next step for the Fed, if we do get another nasty sell-off, is to get into buying stocks, you know, stock market ETFs. That could certainly happen. We have seen that in Japan and some other countries. I wouldn't put it past them, because they were not really supposed at all. It was actually against the law for them to buy corporate bonds, but they found ways to do it, and at the end of the day, there wasn't any real opposition. I don't think there will be opposition, really, if they start buying stock market ETFs, like, you know, the SPY ETF and stuff like that, and maybe specifically sector ETFs, like, I think one ETF that could certainly be on the buying list for the Federal Reserve would be the XLF. That's the Financial Select Sector ETF, because, you know, the financial industry is obviously very important for the Fed and the overall stability of financial markets. The reason why XLF could be on the buying list for the Fed is because of, you know, it hasn't made the recovery we have seen in other sectors. This is much weaker. And you see that we are testing this key support level here at the 50-day moving average. So this is looking quite vulnerable. If we do get a bit of a pullback, maybe if we get below here, I think we seriously could see the Fed just, okay, we have to protect XLF. That could happen. So definitively, we live in very, very, very wild times where all the old laws, of finance are broken, and this is one of the reasons why many professional economists, they look like fools nowadays, because all the theories they have are just going out the window. Even though they are kind of correct, when they say that, oh, this market doesn't make sense, it shouldn't be where it is, and the valuations don't matter, and all of that. They are correct, but the market is also driven by other forces, and the most powerful force is the basics of, are there more buyers than sellers? If there are more buyers, the market will go up, regardless of all the more real factors, like the health of the economy, future prospects of earnings, and all of that. Whatever you do, don't fight the trend, and one of the trends you should be super careful about fighting is the Fed. Then again, do not worship the Fed, do not think that they are omnipotent and that they will always protect the market, because throughout history, thousands of years of human history, we have seen very powerful forces try to protect markets, and all the other empires have collapsed. So yes, there are limits. And some of the previous empires we've had were way more totalitarian and powerful than the US, than America. Far more powerful. America's democratic-ish, and needs to make all kinds of concessions and support human rights and stuff like that. Previous empires like Rome and the Mayan Empire and so on and so forth, they didn't have to care about that. But even them, with all the power they had, they couldn't, prevent the inevitable. May the trend, of course, be with you.